Awesome. So, hi everyone, welcome to our AMA. And today we are talking about something that's been on my radar for a while, institutional grade funds going natively on chain. And it's not just synthetic exposure, it's actual fund shares from BlackRock, Brevan Howard, Hamilton Lane, tokenized and composable in DeFi. So, my guest today is Chirag, Chief Commercial Officer at KAIO. And they've just closed a strategic round backed by Tether, and they manage around $100 million on chain. So, Chirag, welcome, first of all, and explain us in a couple minutes in plain English what exactly do you do and how is it possible?
Yeah, definitely. Firstly, thanks for having me. And yeah, happy to explain. So what KAIO does is we look at the highest quality assets that exist off chain in the real world, hence the RW in real world assets, and we bring them on chain. We do that with in a regulated setup. We only select tier one institutional funds, and then we bring them on chain for on chain capital, which can either be accessed via accredited investors who go through a very familiar KYC process. And in that instance, they'll have exposure to an asset on chain with legal recourse to the underlying. Or you can access it permissionlessly, which is something we can talk about later, which we are rolling out in the near future. That doesn't require KYC. It doesn't mean it means you won't get the legal claim, but that friction is no longer there for retail. So it's a dual track that we'll launch.
Amazing. And so your protocol integrates with funds like from BlackRock, Brevan Howard, Hamilton Lane. So what was the vision behind starting with this institution, and why is this so significant for people who don't understand these names?
Yeah, definitely. Look, the beginnings of KAIO was from Brevan Howard. So it was incubated at Brevan Howard, and the idea was, can we see if we can tokenize a hedge fund and bring it on chain and expose, democratize access to a fund or an asset like a hedge fund to the on-chain world, which isn't really accessible unless you have, a private bank relationship and you're sitting in the off-chain world. So that was the first test case. Can we actually bring something as complicated that in a regulated way in on-chain? And we did that with the Brevan Howard Master Fund. And from there, we sort of continued to see that actually, the on-chain world has access to endless amounts of strategies on DeFi or token opportunities, other investment opportunities, most recently with tokenized stocks, etc. But they don't have access to money managers that sit off-chain, which traditionally have been only for the private bank individuals or high net worths. And so we decided to bring that into a standalone business and continue the route down of focusing on high quality assets where you didn't have access before as retail or under a certain threshold and criteria, and bring those assets on chain. So screening criteria for us is it's got to be a tier one asset manager, managing multiple hundreds of billions of dollars in the real world, to make sure that what we're bringing on chain is credible and uncorrelated to crypto, to DeFi risk, and enable that to be a path for on-chain users. And that's what we've continued to do and we'll continue to do so.
That's super interesting. And for a regular on-chain user, like what is a particular benefit? Of course, beyond like access, liquidity, 24/7, composability and yield. So what they should understand.
So right now, if you're sitting as a retail user, you have and you're managing your own book, you have one side of you that maybe wants to make the moonshot bets and pick your token or pick the meme coin that you want. But there's another portion of you that needs to manage money and be more, risk adjusted in that factor. So normally what you would do is you would go lend it in an Aave pool or a Morpho pool or something that is, inherently crypto. And what we want to do is say, as an alternative, if you want to have access within the same UX and framework that you have, we're going to let you allocate to something where there are, professional money managers that sit off chain and give you that yield without having to off ramp, without having to have a relationship with any, external party apart from us. And that way you can manage your portfolio in a much more cohesive manner.
I got it. And like I have a very important question here because as we know, all these institutions require like QIC. They have strict requirements for regulations, for compliance. So how do you handle this side? And
Yeah,
like because like on chain, people can have access from anywhere, even from restricted regions. So yeah, please
yeah.
explain.
But just before we do that, I have to say that you can split the on-chain world into, I'm oversimplifying it, but if we split it into two, you have one section which is still in this, qualified institutional on-chain capital. This could be from on-chain treasuries, whether it's, Ethena or MakerDAO. And then you have retail. And so if we sum up all of the capital, it's sort of broadly split into these types of groups. And so for that first group, they are completely fine with doing KYC, AML, qualified, accredited investor checks, because they want to make sure that they have legal recourse to the underlying. So when they come to the KAIO protocol, they have that option. They can go through the accredited investor check, which uses one of our third parties for them to be qualified, and then they'll be able to subscribe directly to the KAIO tokenized version of the underlying asset. And if you don't want to do that, if you're someone that's retail, maybe someone like you and I, who doesn't want to have to go through that, we are launching a suite of permissionless RWA products. So this is where you won't have to KYC or do anything. You'll be able to buy and sell freely as you do with any other DeFi or native on-chain token, and you'll still get exposure to the underlying assets, value or appreciation. The only thing is if you won't have legal recourse to the underlying, but for the majority of people in retail, that doesn't matter for them.
Okay, and for these permissionless RWA products for retail users, so what exactly does the buyer hold on chain?
So you would hold essentially, so for example, the actual underlying fund, let's say a Hamilton Lane fund, this is tokenized by us in the standard way that we do it. We would then mint a retail version for you. You can either call it synthetic or a mirror, or we haven't exactly pinned down the exact branding that we're going to use, but it is a token that represents the exact one-to-one value and appreciation of the underlying, which themselves will be immobilized. So you will have a freely tradable asset that gets exposure for that Hamilton Lane fund, which is appreciating by the yield of the Hamilton Lane fund.
Okay, and does this structure have some limitations and maybe protections for users?
It means that if KAIO blows up, then you wouldn't be able to take that unit to Hamilton Lane and say, hey, I have this thing, because you didn't do the accredited investor KYC route. So that option is always there. If you are retail and let's say that position's grown to a certain size and actually you are wanting to have that extra bit of protection, that option is there. You just come in KYC.
Okay, got it. So yeah, it's basically what I want to hear, because it's like fully compliant version, not something that like live only on chain and there is no real representative in the real world. So I love it. And I know that some of these funds have pretty high level of entrance. So do you democratize
Yes.
that as well?
Yes, definitely. So there's some of the more alternative asset funds like private equity funds, hedge funds. The one we're going to launch in the next week, I won't say the name, but it's coming soon. I think the minimum is like $2 to $3 million per ticket. And so where it was with us, it ranges depending on the asset, but the smallest ticket you can do is like $100 for like our BlackRock fund, all the way up to $1,000 for some of the more complicated ones. So, you don't need $2 million now, you just need $1,000. That's one really important part of democratizing not only the access, but the entry requirements to get into these.
Yeah, that's amazing, because like before these products were available for limited amount of people, and now like liquidity and 24/7 access is something important. But what is much more important here is that it get like pretty accessible for everyone. That's amazing. So you don't need to have like $5 million right now in capital. You can start with like a couple thousands and get the same exposure that only big money had before.
Exactly.
Okay.
We listened to the market. We wanted to make sure that the best opportunities weren't just left for, the super high net worths, and, why shouldn't everyone be able to have access to it? And so that's what we're trying to do.
Yeah, and I'm curious, like what funds are available right now? So let's dive into the funds themselves and which strategies, which funds are available, and yeah, like maybe a couple of words about it.
Yeah. So right now we have the BlackRock money market fund. So this is one of the largest funds that sits externally in the robot. It's $112 billion. And that is your box standard exposure to treasuries. If you want treasury yield, you don't want crypto yield. This is where your starting point is. So that's ready. That's on chain already. We have the Hamilton Lane private credit fund, which I think is pretty well known in the market. We tokenized it. I think Securitize also tokenized it. This gives you access to exposure to private credit markets. It's previously yielded between like 9 to 12%. Obviously, there's risks involved, and the credit markets have had a bit of a wobble in the last 6 months. But that is also one that we have live. A third one is the Laser Digital Carry Neutral Fund. I'm sure I don't explain the carry neutral trade to our crypto listeners. So that's one managed by Laser Digital, which is the crypto of Namira. And then the fourth fund is from Brevan Howard. So it's their flagship master fund. It's actually not open to any investors, whether it's off chain and you've got $20 million, you're not allowed. It's only accessible via KAIO, via the tokenized feeder that we have. So that's a macro fund that Brevan manages as well. Those are the four, and then we've got one coming live next week, which I think I can mention as well, which is a sovereign wealth fund called Mubadala, which I don't know if you're familiar with it, but we're the first platform to tokenize a sovereign wealth fund, so the Mubadala Capital, and that's going live next week as well. And then there's a string of funds that we're going to look to tokenize over the next few months, with the idea of what we're trying to call the RWA yield curve. We want to have something that both low risk, low yield, high liquidity investors can access, all the way up to high yield, high risk, and then maybe less liquidity, and then every sort of point, from A to B along that curve, something for everyone.
Yeah, but you already have a strong mix of different funds and assets, like for different appetite of risk. And when someone evaluates these products, what materials do you provide on chain or off chain? So can they access manager quality metrics, fees, underlying risks? So how do you work with these kind of things?
Yeah, so when you go through the accredited investor routes and after you go through the KYC and your onboarding, you'll be able to see the PPM of the fund, the tokenized version, which will lay out all the details of the fund itself. And in there is fund fact sheets about like performance and volatility, Sharpe ratios, all the kind of things you would see in normal fund docs. And then if you did want to go deeper, the vast majority of the funds that we have brought on chain and that we will continue to have tons of available information on their own websites, and we can direct you to those, and it's all very public information. There's not anything that we share. Essentially, if you invest in a KAIO tokenized fund, you will get exactly the same exposure and information and value that you would if you had invested in the normal TradFi world.
And do you charge something additional for managing this on chain?
Yeah, we charge. We have a basis points model on top of the underlying management fee, essentially, that goes on top the access to the tokenized ones. But our game is sorry, go on.
Yeah, it differs from fund to fund, right?
Correct. Yes. So typically, the more complex funds, like the private equity, the hedge funds, which are very complex, have different share classes, and are a little bit more challenging to bring on chain, will have a slightly higher ongoing fee, whereas something like the BlackRock money market fund is very, very low.
I see. And coming back to BlackRock money market fund, so we already know that BUIDL is already here, right? It's the biggest RWA product so far, with cap around like $3 billion right now. So what is the idea for, let's say, conservative investors and institutional to choose, first of all, your version of it? And what are the new benefits tokenization unlock for institutions?
Yeah, sure. So firstly, ours is cheaper. So if you really wanted to save some fees on the basis points, ours is cheaper. The second thing is ultimately, depending on your risk appetite and specific requirements, some on-chain protocols have a requirement that it has to be 100% treasuries only and no agency securities, et cetera, et cetera. So depending on what that is, will also dictate whether you pick BUIDL or you pick ours or you pick super states or any of the others. But broadly speaking, I'd be remiss if I said that the exposure generally is the same set of it's a money market instrument at the end of the day. So it really just depends on the fees you want to pay and specifically on the underlying securities, whether you want treasuries only or you're okay with agency. Ours is the money market fund we've chosen is the ICS USD liquidity fund. So it has agency securities in there as well, which means it actually yields a little bit above the benchmark, which is suitable for some, but it's not suitable for others. It depends very much on the risk appetite.
I got the idea. And let's talk a bit about adoption. So far, you noted over $100 million in tokenized assets, like which is impressive. But I read before even like $2 billion in tokenized. Then I check the real on-chain statistics and do not see any evidence of that. Like one holder or like 10 holders, no movements at all, and you just believe white paper, not something that you can check on chain or like prove. So how it works in your case, and who is the main like client maybe in your case? Is it institutions or retail investors?
Yeah, so look, adoption has been slower than we've all expected. I think I could speak on behalf of us and our peers in general. And that's just because the institutional qualified investors, the pace at which they come on chain just hasn't come as fast as we expected. And you're right to look into the details because as soon as you start uncovering some of the large numbers, you'll see it's like, oh, it's all held by like 2, 3 wallets. It looks a little bit inorganic. But that's fine. These protocols and TVL and they all need to be bootstrapped in some type of way. But what our recognition is that the institutional side is coming. That on-chain capital, like let's call it the professional on-chain capital, so the treasuries of the world are growing, and we think that will come more, albeit slowly. And so we are targeting that market. We have been. That's all of our TVL at the moment is in sort of foundations and on-chain treasuries. But we think on-chain money managers, more family offices, private market platforms transacting on-chain, that will be part of our go-to-market in the future. It's just taking longer than we expected. And to supplement that, the market that is here today, which does transact, is the retail market. And this is why we are launching this suite of products, these permissionless RWA products that will be able to be accessible for retail too. Our idea is each product that we bring on shall have a dual track, whether it's the accredited investor institutional side, where it will come, it'll be slower, and then the retail money that's ready today that can allocate to it.
And for retail adoption, what do you think will be the main driver, like better yields, easy access, DeFi composability, or just trust in the underlying brands?
I think it's a few things. So one is access to higher than treasury yields, which competes with DeFi yields, but without the risk, is very appealing to retail and on-chain treasuries. I think the second thing is utility as well. We're working with some partners in the industry where, previously, for example, if you hold a Hamilton Lane fund as an example, or any of the kind of more illiquid assets, you would have to wait a quarter or even half a year to actually get liquidity on any of these assets. And when you do want to do a secondary transaction, for example, it's very cumbersome, it's manual, it's static PDFs, lawyers are involved. it could take months to and more even to actually do a transaction. Whereas some of the counterparties we're talking to recognize that if you're holding a tokenized unit, if I'm holding a unit of the Hamilton Lane Fund and I've got 45 days before the quarterly redemption window hits, but I actually want my liquidity now, through a tokenized secondary liquidity venue, I could send it to you straight away through pricing a discount, right? Through until the duration window. So those platforms are existing, and I think adding utility to these tokenized assets is something unique to our world that you aren't able to do off chain. So I think it's going to be utility, access to yields that is higher than treasuries, that doesn't that competes with DeFi. I think those are the two main things. They'll drive adoption.
Yeah, that makes sense. So let's talk about like your roadmap, future vision, and so on. So first of all, on your website, on the main page, we can see that cash is under announcement, right? And it's like permissionless, institutional grade, on-chain yield. You promise something around 8% annually. So sounds amazing, but like any other yield-bearing stablecoin. So what is it exactly, and how it's different from, let's say, Ondo's USDY or USDM or other like yield-bearing stablecoins?
Yeah, so Cash is the first version of the permissionless RWA suite of products that I was mentioning before. And just to one clarification, it's not going to be a stablecoin. So this is enabling users to have permissionless access, no KYC. You just come, you buy the underlying asset, and you will get the yield via an appreciating asset that matches the underlying exposure. And so where we're saying 8% is the range of products that we're bringing on will map that of what we have today. So it can be as low as something like 4.5% if it's the money market fund, or it could be as high as 12, 13% if it's the private credit yield fund. And then we'll have everything in between. So you'll have a suite of permissionless products that you can access, which will yield around 8%, depending on which one you go for.
I see. And I have another question regarding like your roadmap. So let's imagine in 12 months, how do the success look like for you? Like more funds, more TVL, more adoption in terms of user. So explain this.
Yeah, so on the supply side, expect to see a lot more funds from a lot more managers with tier one large names, giving you exposure to different areas of the TradFi market that you don't have today, whether it's from CLOs or high yield corporate bonds, EM exposure. We're going to bring as much as we can to have a diversified portfolio of traditional assets on chain from tier one managers. That's one thing. The second thing is, and this is sort of us working with the industry, is a bit of a aligned view here, that we want to make sure that these assets are permissionless for retail, but also composable as well. So you should be able to, what we want to see in the next 12 months is that you're able to pick any one of KAIO's permissionless assets, or the permissioned ones as well, the accredited ones, and be able to borrow against them. You should be able to go to any of the major borrow and lending protocols and generate yield across them, looping on them. We want to be able to see some of the more vanilla assets, like the BlackRock money market ones, being used as margin for perps trading, essentially like full integration within DeFi, except where the underlying is a stable or well-known TradFi asset that we can value, and there's trust in the liquidity in the underlying manager. And then the third piece is, as I mentioned, this utility, where there's a much deeper secondary market for these underlying assets, which takes out even the remaining friction of holding these assets. So everything should be free flowing, and yield opportunity should be very large, from low risk to high risk.
So, like in your case, the success is not like bringing more on-chain funds, first of all, but let's say add more cases in DeFi, so using the collateral, lending, and so on. So, and to enable that, what still needs to improve most? Like maybe it's legal rails, Oracle infrastructure, protocol integrations, market making. So what is the like key bottleneck, right? See.
There's quite a few. There's because we operate in the traditional world as well as the on-chain world. You hit the nail on the head. Reg has been problematic for us. So depending on where your underlying feeder fund structure sits, whether it's Cayman or BVI, etc., there's slightly different nuances and rules to whether you're allowed to have secondary trading, as in changing hands between whitelisted KYC counterparties or not. And so we're sort of at the mercy of that reg a little bit to fully rolled out and have have institutions comfortable with it, have our internal compliance teams comfortable with it as well. So that's definitely a pain point that I think will continue to evolve. I think the Clarity Act coming, if it passes, will also be a step in the right direction to help with everything that we're doing. And then the second thing to solve is really getting demand on chain, whether it's from having these permissionless products for retail or these institutions on chain managers coming in through distribution platforms or being serviced on the access being surfaced on neobanks or wealth management platforms. Is getting those guys in as well is the two main things that need to be solved for the next 12 months.
Mm-hmm. And in your opinion, this distribution will actually happen because of like wallets or DeFi apps, or through centralized exchanges, or maybe we are dedicated RWA platforms. So what is the key driver to this?
Yeah, it should be both. I mean, if you're KYC'd and you're sitting on an exchange platform, or if you're sitting in Robinhood or a neobank, anywhere across the world, again, you're managing your portfolio, whether it's trading stocks, trading pre-IPO, whatever it might be. You should then be able to say, hey, I also want to be in and out of these RWAs that KAIO and their peers have brought on chain as well. So that's a captive audience that will unlock a huge amount of demand for these assets. But people sitting natively in MetaMask or Phantom should be able to generate yield on their idle balances, and that could be from what is being offered today, stablecoin yield. But there's no reason that you shouldn't have an RWA yield piece on your on your MetaMask tab that enables you to plug into some of the more higher risk assets as well. So we need to integrate across both and all of it to be able to have fungibility and provide access to all of the uses.
Mm-hmm. And I have another question to you. It's a bit like a side question, but still. Yesterday, I went across statistics of crypto neobanks, which are a lot of right now, right? And the only one is profitable. All the rest are deeply negative. So I'm curious, do you think your product, like, first of all, are you considering neobanks as a channel for distribution? And like, do you think your product can improve the like economic model? And maybe you have also planned to launch some kind of neobank in the future under your umbrella.
Yeah, wow, KAIO neobank, that would be interesting. I can't say it's something that we've discussed at length of having our own neobank. That is, but no, absolutely, we are in late stage discussions with a couple of neobanks about integrating our products. Ultimately, if there's user demand for it, then that neobank's economics will profit off the back of it. And so, the one we're talking about in question currently offers stocks in the traditional world, and has that exposure to, and you can get exposure to BTC, Sol, etc. It's a very basic crypto token investing. But there isn't so much in yield strategies and with the names attached, like the Brevan Howard, the Hamilton Lanes, the BlackRocks, etc. for that user base. And so the bet is that you're providing a full suite of investment products, and investment products generally in neobanks are the more profitable region, right? Like card spending is not necessarily, it's like the loss leading part of the majority of neobanks. So it's directing that user base into more investments. And if we can offer something that they can't access easily because of whatever jurisdiction issues they have or access, and we can plug and play and say, hey, surface all of KAIO's RWAs, and that's great for the user base, then for sure they will benefit. But I like the idea of launching our own neobank. Maybe that's something we do in 2028.
Yeah, like in my opinion, it's a big interconnection between, I mean, in traditional finance. So usually a bank provide access to, like, at least for their private clients for investment assets. And here on chain, it opens a lot of opportunities. Like you can borrow under your assets that you already have. You can earn passively on what you hold. Let's say cash is the main asset on your crypto card, let's say. So yeah, I think it's an interesting concept that can drive more audience to your product as well. And give me the honest answer. So what is the single biggest risk that could slow down institutional capital going on chain?
The biggest risk. I mean, institutions that are allocating on chain at the moment, the slowness comes from the fact that when they are making the decision, it doesn't come easily, right? We get 50 pages of requirements and credit requirements, or the entire platform and the asset itself is very deeply DD. So after that level of scrutiny and diligence, I don't see much risk of them having an issue or pulling away. So then the only issue, like the only risk that could happen is if one of these platforms, it won't be us, but one of these other platforms potentially blows up in spectacular fashion because they haven't done something correctly. That could cause, some scare in the industry. But away from that, I don't see a huge risk because at the end of the day, the underlying asset that we're bringing on is in a huge, traditional manager's asset, which has hundreds of years of pedigree. Now, if one of those managers blows up, I mean that's finance kind of having a broad issue as opposed to anything to do with tokenized assets. So the risk is very. I don't see much risk, to be honest, in slowing down institutions coming in, unless there is some new reg that comes in that I can't even imagine, which all of a sudden reverses course on what is allowed and what isn't. But that's we can't sort of plan for that, and so I don't see huge risk unless one of our peers explodes.
Yeah, so major risk lays not on chain, but off
Off
chain,
chain,
let's say.
maybe.
Yeah, and it exists whether product is on chain or off chain. It doesn't matter at all in this
Exactly.
case.
Yeah, we're all screwed at that point.
Okay, okay, Chirag. So now we have my favorite part. So it's a
Okay.
rapid fire, like short questions, short answers. And what is the biggest misconception about bringing institutional funds on chain?
That it's already here. It's not. It's coming.
Yeah, I agree. Still, people think that it's something like institution separate from on-chain. No, guys, they are
Yeah,
already here. You can use
yeah.
it. Okay, so one metric that you will obsess over in the next 6 months.
I would say I don't want to say something cliche. So let's say demand for KAIO's permissionless products. That's what I want to see.
Okay, yeah. Well, I think it only depends on the distribution channel. So, for
Yeah.
example, if you build this under, let's say, Plasma card, which I use right now, I'd love to use like cash, not USDC, like earn a protocol for like 3% yield on chain. So why not?
Yeah,
Like,
look, we're close with the Plasma team, right? I've been trying to talk to them about enabling RWA yield for Plasma users. So fingers crossed, you might see that soon.
yeah, let's see. Okay. So if a major player or TradFi player wanted to acquire KAIO tomorrow, so what's your answer and what's your number?
$10 billion.
10 million. Okay, I love
Not a
it.
penny less.
So can I borrow against my macro tokens today? If not, when?
Your macros, BH macro. They're not today. No. So the main borrow lending platforms out there for RWA assets are Aave and Aave Horizon, and then via Morpho as well. And you have to go through a process to make sure the assets are eligible and make sense to borrow. So we're starting off small and slow, right? So the money market funds and the Hamilton Lane funds, which have deeper liquidity and the most demand, they're eligible. But macro, not yet. It's a bit of a trickier asset, candidly, to borrow against because the liquidity profile isn't the easiest to change hands and to redeem quickly. But adding some of the utility that I mentioned before, which will enable you to redeem and get liquidity before your window, we think will mean that once we've got that in place, you'll be able to have your BH macro asset, borrow against it, and the liquidity can take it and redeem and get their liquidity. That is what we're heading towards, but it's not here today.
I got it. So look forward to it. And what is the hardest thing you've built so far or navigated so far?
Probably this permissionless products is the hardest one, right? The foundations of what we were building all kind of sat in the world of qualified accredited investors, which we understand super well based on our DNA, right? It's Brevan Howard, it's Nomura incubated. Everyone on the team has like a TradFi or a background basically, and so it's a well-trodden path that we understood. Getting something in the hands of retail, which is regulatory compliant and has liquidity, was a much harder task for us.
I got it. So, Chirag, thank you. Maybe you want to add something.
Guys, look out for what's coming this year. There's a lot, both on the traditional side, but also on the retail side. So stay tuned. A lot more announcements to come. And thank you for having me.
Amazing, love it. So yes, this was a really great conversation, and I love it. I love that we finally have this kind of institutional grade products on chain, and it's not like another like wrapped product which we already can trade in our brokerage account. It's something that really provides benefits for everyone because at least it give you access for something that was limited by its like core idea before. And yeah, I love it. So I'd love to see more like usage scenarios, more distribution channels, so we can use it in our like crypto neobanks as core products, borrow under these assets. And yeah, I love that it comes. Finally, crypto world makes more mature and trustable. So yeah, thanks for such projects as you have. And thank you, Chirag, for joining us today. So hopefully like 400 people that join us gave clear picture of what you do, and will use your product as well. So follow us, follow KAIO, follow me, and let's make this crypto world better, especially in RWA space. I think it's the biggest opportunity right now in crypto. So thanks again. Thanks everyone.